Indexed UL can double cash value every 7 to 10 years if it's structured correctly. In this episode, I'm going to address the question, which universal life option has a gradually increasing cash value? Now, that's a very interesting question, and I've been asked that numerous times in the 46 years that I've been a financial strategist. So in this episode, get ready, because I'm going to show you what I think they were actually asking, and also which universal life actually allows you to have a dramatic increase, not just gradual increase in the cash value every single year. So I'm Doug Andrew, and I've actually had a life insurance license from 1974 when I started. I kept it clear until 2005 when I finally just let it expire automatically to become a consumer advocate. But I have continued to train over 3,000 CPAs, tax attorneys, and life insurance advisors, real estate professionals on how to optimize assets, minimize taxes, and also choose the right type of life insurance based upon the goals that people express. So when people ask me, well, Doug, which universal life? So first of all, I go, okay, at least you understand we're talking about universal life, because between term whole life and universal life is designed for living benefits. The cash value increases. It's designed to give you tax-free income, is the reason why E.F. Hutton came up with it, primarily for living benefits, for income, rather than just the death benefit, which is what term and whole life is primarily designed for. So when they say, which universal life, I go, okay, they're on the right track, has a gradually increasing cash value. Now, normally, they really mean to ask which one has a gradually increasing death benefit. Well, that comes under usually option B. Some companies it's option A, but that's where the cash value inside your insurance policy, as it grows, as it does increase, the death benefit. That's usually what they're asking, but they didn't ask it that way. So when they say which universal life has gradually increasing cash value, well, if you said gradual, my answer would be a poorly designed one. They go, huh? Well, if it's gradually increasing, then it's designed poorly. And unfortunately, a lot of universal life insurance policies are not designed to give you the best internal net rate of return. What do I mean by that? In a universal life insurance policy, when E.F. Hutton, who is the brainchild behind them, and they weren't in an insurance company, they were a brokerage firm, and they said, hey, in 1980, why don't we take away the volatile risk of having your money in the market and put your money into a legal reserve insurance company, and instead of trying to get the most insurance death benefit for the least premium, let's flip it. Let's do the opposite. Let's get the least amount of insurance the IRS will let you get away with and put in the most money as fast as the IRS allows. And it turns into a tax-free cash cow for living benefits. It means that if you threw in $500,000, which I had many clients do back in 1980, $500,000 was earning net internal rates of return of 10% or more. Let's just use 10%. That means $500,000, unless you're taking income instantly. $500,000 doubles to $1 million at 10% in 7.2 years. In 7.2 years, your $500,000 is now worth $1 million, tax-free. In another 7.2 years, your million has grown to $2 million. Another 7.2 years, to $2 million, $4 million, $8 million. We have people who started out with $500,000 that now have $8 million. At 10%, that generates $800,000 a year of tax-free earnings. If you take it out, it's tax-free. If you leave it there, it's tax-free. So that's not a gradually increasing universal life. that's increasing at a pretty doggone good net internal rate of return, doubling your money every 7.2 years. And so my goal when I structure a max-funded indexed universal life insurance, because you will not generally have a gradually increasing cash value, you want to have it growing great rates of return averaging 7 to 10%. And that's normally not defined as gradual. What happens is when you design a universal life policy with the least amount of insurance that the IRS will let you get away with and put in the most premium, many agents don't know how to do that, but you're trying to earn a rate of return net, cash on cash, within 1% of the gross rate of return. So if I earn 8, I'm netting 7. If I'm earning 9, I'm netting 8. If I'm earning 11, like I've averaged for the last 27 plus years, I'm netting 10. Only one of those percentage points is draining out of that account to pay for the insurance, the cost, the fees, and everything else. So I'm netting 10. If you're netting 10, your money's going to double every 7.2 years. If you have $1 million in there and you want income, that will generate $100,000 a year of tax-free income. Now, unfortunately, many times people come to me and they'll go, hey, I bought a universal life policy from my nephew or from my brother-in-law years ago. He used the same company that you use, Doug. I actually use several companies, but he used one of the companies that you used. In fact, he used the exact product. And I look at it, and it takes about 30 seconds, and I go, who designed this? Our nephew, or my brother-in-law, he has an insurance license. I go, he didn't design this very well. He earned a nice commission off of this, but it's been earning 8%, but you've only been netting 2. You've only been netting 3. So what's happening is your money's not growing. It's gradually increasing, but sometimes it's not even doing that. And I'm going, who designed this? What was the purpose? Well, I wanted it to be used for tax-free income. Well, you've been earning 8 and netting 2 or 3. You could have been earning 8 and netting 7. In fact, you could have been earning 11 and netting 10 if he used this product or designed it this way. But he didn't know what he didn't know. So when people ask the question, which universal life has a gradually increasing cash value, I go, one that wasn't designed the best. Because if you have one designed correctly for that purpose, it's not going to be gradual. Your money should double inside that every 7 to 10 years. It's indexed universal life that allows you to have more than just a gradual increase in cash value. And so what does all this mean? So if the answer is, well, just about any of them can be designed to have a gradually increasing cash value, if you're satisfied with 2%, 3% net rates of return after costs and fees. But if you would like to have the highest net internal rate of return after costs and fees, it's very critical that you design it with the least amount of insurance under the tax citations TEFRA, DEFRA, and TAMRA. TEFRA means the Tax Equity Fiscal Responsibility Act of 1982. DEFRA is the Deficit Reduction Act of 1984, and TAMRA is the Technical and Miscellaneous Revenue Act of 1988. When you create a universal life policy that will accommodate $500,000, $100,000 a year, $10,000 a year, $1,000 a month, $1 million, $10 million, you take the least amount of insurance under TEFRA and DEFRA based upon your age and gender, and then you put in the money as fast as the IRS allows under TAMRA, and you fund that in 5 years or less, and this thing turns into a tax-free cash cow. Now, if you use indexing and you rebalance, if you just use indexing, in the worst periods of time, you'll probably earn 7, which means you would net 6. On the average, you'll earn 9 and net 8. If you rebalance, then you'll earn about 11 and net 10. So I would recommend you use Index Universal Life and you rebalance the portfolio every year and you'll likely earn what I've earned, 11.17 average for the last 27 plus years, netting over 10%. That is not a gradually increasing cash value. That doubles my money every 7 years. And so if you want to learn more about how to do this and how to design it correctly, or be able to tell if your policy, if you own one, is designed correctly, you ought to have a comparison. You ought to have an audit done. But I want you to learn the basics before you do that. And so I'm going to share with you an opportunity on how you can study and read my most recent best-selling book, and also how you can engage and have a professional do an analysis to see if your universal life policy, if you own one, is performing at its optimal best, and what you can do to make it better, or maybe you do a tax-free exchange into one that can do better for you. So here's how you can get a copy free of my most recent best-selling book. I've written 11 books. This is my 11th one. It's called The Laser Fund. I call a max-funded, tax-advantaged universal life insurance policy the Laser Fund because it's an acronym. It stands for Liquid Assets, Safely Earning Returns. This is the only vehicle, indexed universal life, that allows you to accumulate your money tax-free, access it tax-free, and when you die, it blossoms and transfers tax-free. When you do it properly, it's incredible for the net internal rate of return. So I call it the Laser Fund, how to diversify and create the foundation for a tax-free retirement, where every $1 million can generate $100,000 a year of tax-free income for as long as you live. If you would like to claim your free copy, don't pay $20, the retail. Claim your copy by going to laserfund.com, L-A-S-E-R fund.com. You simply pay $5.95 shipping and handling, and I'll fire out a free copy to you. There's options in there for audio and video training also. But folks, this will empower you on how to have a universal life insurance contract that will perform not just gradually with your cash value increase, but dramatically. And I'm sure that's what you would like.